Welcome into the video, everyone. Today I have a new cheap stock for you, and this one is trading below its original IPO price. You see, buying a stock that's already hyped up and uptrending is cool and all, but when you see an ugly chart like this, oh my goodness, that's where a lot of money gets made. For example, the last time I did a video on two stocks trading below IPO price, it was on Fetch, which ran up over 166% at its peak, and Upwork, which ran up over 285%. And two turnaround plays that I bought were Maxer, which was down over 70% from 5-year highs and turned into 180% plus gains, and Bed Bath & Beyond down 65% after 5 years, and if you bought in and still holding, today you're up over 50%. So I can't promise anything, but this new software stock I'm about to talk about could be a similar story. Let's do it. What's going on, everybody? I Need a Haircut, and today we are talking all things Zuora, ticker ZUO. Already, their customers include Zoom, DocuSign, Car Gurus, Headspace, Kia Motors, TripAdvisor, Autodesk, Box, Okta, Zendesk, BigCommerce, Illumina, Ford, Deloitte, Zillow, and much, much more. All of those companies offer some sort of subscription service, and Zuora is the one helping them power it, and I still think Zuora is undervalued. Let me tell you why they have these massive names as customers. Give me the format. First, we'll talk about not just the company, but the huge opportunity they're chasing in what's called the subscription economy. Then we'll talk about why I think it's a very attractive turnaround play, and we'll talk about the insane new management. After that, we'll get into the juicy financials and a bit about their valuation, and finally, the risky risks involved, exactly how much of this company I own, and what I'll be doing. To kick it off, Zuora is a cloud-based subscription management platform that enables companies to launch, manage, or transform into a subscription business model. So every time you subscribe to something, it might actually be Zuora running things behind the scenes. Zuora, myself, and many others believe we are in a multi-decade global shift toward recurring subscription-based business models, or what Zuora has trademarked as the subscription economy. In a report written by Zuora called the Subscription Economy Index, or SEI, they charted out the growth of subscription businesses versus traditional businesses in the S&P 500 and US retail. Here you can see that the SEI revenue has grown by over 430%, or over 5x since 2012, while the others are lagging behind substantially. What's even crazier is that in 2020, subscription businesses in the SEI grew revenues at 11.6%, versus product-based peers declining by 1.6%. And in Q4 of 2020, subscription businesses 7x'd S&P 500 sales. To give you an idea of how big the subscription economy really is, let me put it into everyday context. Let me describe the average day. 5 a.m. you wake up, you start reading the New York Times because you're always on top of those current events. Then you pop in your headphones and listen to your favorite business and productivity podcast on Spotify Premium or Apple Music. After that, you're hopping right onto the Peloton to crush a few sessions because you're a fitness god. Your body is your temple. And then after that, you're eating breakfast and watching Netflix, Hulu, HBO, Disney Plus, whatever suits your fancy. Then you remember, oh yeah, I'm a business mogul. So you realize you have a meeting at Panera, which they say is the golf course of the 21st century. You grab your subscription coffee once you get there, which is a service they actually have. You talk to your supply chain manager about which machines at your business are efficient, idle, or at capacity, and that's data analytics you have on those machines because you subscribe to them from the manufacturer. After that, once you use your Uber Lyft pass to get home, another subscription service, you see on your beautiful doorstep a Stitch Fix box with your personalized and customized fashion solutions, and then also that meal plan service you also subscribe to. Then once you walk in your door, you have your meal, and you wind down with maybe some Audible, or you're reading a book on your Kindle. Then you realize, oh yeah, I'm such a hustler. I also have this side business, which you launched on Squarespace or Shopify. And after all of that, after a very productive day, you lie in bed and realize everything I just said and everything you just did was a subscription service. So that was definitely a lot, but the point is the subscription economy is growing into more and more areas of our lives, and it is growing at an alarming rate. And Zuora is one of the main players making all of that happen behind the scenes. And the reason these companies need Zuora is because subscription business models can actually get really complicated behind the scenes when it comes to scaling, different product offerings, adding and reducing different features, recognizing revenue, and all this different stuff. But to keep this video simple, Zuora takes all of that and automates it and makes it really easy to manage and understand as a business manager. So this is a peek at their central platform, which includes pricing engines, subscription order engines, rating, global payments, analytics, and of course, accounting. They've essentially created a one-stop shop for end-to-end subscription management. And Zora collects revenue in 3 ways. One is the platform fee, where they have 3 tiers, basically good, better, and best, and you pay a higher flat fee for the better tier. Second is volume. Zora is able to collect a portion of all transaction revenue processed through Zora's platform. So as our customers grow, so does the revenue of course, Zora. And you can actually see that they processed over $14 billion of volume on their last Q3 report, which is 31% year-over-year growth. And finally, third is upsells and add-ons, and that's things like Zora Collect, Zora CBQ, and they expect to continue to add more products for upsells opportunities. Naturally, the next question is, who's the competition? Right now, their biggest competition is actually homegrown solutions, meaning a lot of their new customers are people who used to have an in-house solution that they made themselves. But as they begin to pick up traction, they actually need to scale, and their homegrown solutions just won't cut it, so they have to adopt a platform like Zora. And this is a good thing because it means a lot of these new customers have greenfield opportunities, which means Zora is there from the beginning, right when they're just picking up enough traction to require an automated subscription management service and help them grow from a small operation to a massive one. Now that's for most of their small to mid-sized businesses, which they do have as customers, but recently, as a part of this turnaround play, Zora has been specifically targeting enterprise clients. And we'll talk more about that in part 2, why this is an attractive turnaround play to me, and also their incredible new management. There are 2 key things you must understand in order to realize the turnaround opportunity before us. The first is Zora's history and why new management is important. The second is the revenue mix and their sales strategy moving forward. If you're enjoying the in-depth research so far, please make sure to hit that like button and subscribe if you haven't already. That would mean so much to me. Thank you, and let's get on with the video. So this was the leadership team from 2018. They were great at bringing the company from startup to IPO, but struggled thereafter to scale, hence the declining revenues and lack of execution. But now, this is what the team looks like in 2021. Key changes include Todd McElhatton at CFO, Sri Srinivasan at Chief of Product and Engineering, and Robbie Traub at Chief Revenue Officer. But before we talk about all of those guys, we first need to see who's leading this company. The founder and CEO, Tien Zhu. Tien was actually employee number 11 and chief strategy officer at Salesforce before getting Benioff's blessing to leave and start his own company. While at Salesforce, he learned what they were missing, and he decided to go start a company to fill those holes, Zora. He's a visionary when it comes to the subscription economy. He wrote a book called Subscribed in 2018, and he pretty much predicted what would be happening in the future in the subscription economy. And if you watch his interviews, you can tell this is pretty much all he thinks about. So Tien is definitely the kind of visionary founder and CEO that I would not mind having at the head of Zora. Now moving back to the newer leaders, we start with Robbie Traub, who spent 9 years at Adobe before joining Zora. Adobe was one of the first big companies to go all in on the subscription business model, and at first investors hated it. But now they are a subscription powerhouse, and that shift to subscription happened in 2013. That date is significant because being VP of Strategic Accounts since 2012, Traub has managed the most significant Adobe accounts since it all started, and you can bet he'll know how to put Zora on the right path to growth. Sri Srinivasan, nearly 13 years at Microsoft and nearly 3 at Cisco. At Microsoft, he worked his way to becoming CTO of Dynamics 365 and had a lot of hands-on early experience with ERPs. And Sri literally just joined Zora 3 months ago in January 2021. So it'll be very exciting to see what improvements he can bring to Zora's product offerings and thus win more enterprise deals. And lastly, but certainly not least, Todd McElhatton, the new CFO. I watched several of his interviews and it may sound silly, but I really like his vibe. For example, the first time I saw the Robinhood CEO speak several years ago, I did not like his vibe. Anyways, he comes from the background of being a VP at Oracle, VP and CFO of Hybrid Cloud at VMware, and CFO of SAP North America and their cloud business group. And you guessed it, 2 major competitors for Zora are SAP and Oracle. While at SAP, he oversaw a lot of companies that were acquired by them and about the same size as Zora, and he saw them reach $1 billion in revenue. So he knows exactly what it looks like and how to get there. And now we get to talk about his plan. It starts with sales. Before, Zora used to employ a hunter-farmer sales model, which basically means the hunter salesman tries to find as many new clients as possible, and then the farmer salesman tries to milk money out of those clients. This was impersonal, fragmented, and it probably led to higher churn than they should have had, and led to lower customer lifetime value and customer success. Since then, they've completely remodeled their sales process, brought in a new head of sales, and formed stronger sales teams. And this new approach and support will be huge in landing and keeping high-maintenance enterprise clients. In other words, they're not just trying to get new clients and charge them as much as they can up front, then suck them dry. Instead, they're forming long-term valuable relationships over time and offering much better service. This has led to 6 deals with ACV, or annual contract value, over $500,000 in Q3 2020, and they landed the largest deal in company history. So you could say things are headed in the right direction. Additionally, according to the CFO and CEO, their win rates have improved on the sales side, and their deal pipeline for enterprise clients has also increased by double digits. Now, there's another part to this turnaround, which is why I think they can hit 20 to 25% revenue growth in the long term, and it has to do with their financials and revenue mix, which is what we'll talk about now in part 3, their financials and valuation. Looking at their balance sheet, we see they have over $170 million in cash and short-term investments. Their total current assets of $266 million greatly outweigh their current liabilities of $161 million. And about $107 million of their current liabilities is in the form of deferred revenue, which personally I don't think is too harmful. Their debt really does not look that bad. They actually have net cash, which means that they can pay off all of their debts and still have cash left over, which is really great to see in my opinion. Now, moving on to the income statement, we can see that this is where the turnaround play comes back into focus. Subscription revenue is up about 15% year over year, which is pretty solid, but their professional services revenue is actually down year over year. That is part of their turnaround play, which is why it gets a little green check mark. But this is actually something that I think the market may be missing, or maybe they're just not looking far enough into the future. Their services revenue is largely made up of setup and installation costs, which they actually plan to now outsource to GSIs, or global software integrators, as partners. Right now, you can see that they actually lose money on their services revenue. So by outsourcing this and getting rid of it almost completely from their revenue mix, not only will they stop losing money and actually get to make more money, they get to make subscription revenue a larger part of their overall revenue. And what that does is, imagine this. Imagine instead of this past quarter reporting less than 10% overall revenue growth, they could have reported just subscription revenue growth, which again was 15%. That would make investors a lot more happy to own this stock. Well, if they're able to phase out services revenue, that's exactly what's going to happen. Subscription revenue is going to make up the majority of overall revenue and therefore be a more accurate representation of overall revenue growth. So if we can see subscription revenue start hitting 20 to 25% revenue growth year over year, which I think it can, and we see services revenue go almost to zero, then overall revenue is going to look stellar. Now for the rest of the income statement, you can see operating margin improving year over year, and yes, they're not profitable quite yet, but they're actually free cash flow break even as of Q3 2020. And the cool thing is that they set this goal for free cash flow break even by Q4 2020, so they actually hit this a quarter sooner than expected. In terms of valuations, I tried to compare them to SAP and Oracle. So Oracle has less than 5% projected revenue growth, and they trade at a price to sales ratio of 5.5. SAP also has expected revenue growth of less than 5%, and they trade at a price of sales of 4.6. Meanwhile, Zuora trades at a price of sales of 5.3, and it's currently expected to grow revenues at 10% plus. And I think that over the long term, they can hit 20 to 25%. Now I understand Zuora carries more risk and could be discounted because it is smaller and still unprofitable, but even compared to software in general, Zuora is trading quite cheap, and I don't think there's any reason they should be trading right alongside Oracle and SAP. You can also see that using this next 12 months EV to revenue, Zuora is actually the cheapest and on par with SAP in terms of valuation. So earnings are on March 11th in just a few days, and I have a feeling they'll do very well. But that being said, I never recommend trying to make an earnings play because you never know how the market will react or what the numbers will actually be. The recent drop in Zuora's price, however, leading into earnings makes me feel like there may be less downside. But be mindful, they're always very volatile around their earnings. Alright, so what are the risks and what do I own? How many shares? All that good stuff. The risks are simply competition and execution. It is a very competitive space with Oracle, SAP, also Chargeify, ChargeBee, and Aria, and if they can't compete against them and they can't execute on better offerings and better sales teams, then the stock could stay stagnant. However, what I've seen from management so far, what I've seen in their track records, and what they've been able to do in just a couple of quarters since joining Zuora, that gives me confidence that they will be able to overcome these risks. So I'm buying this stock, and I've been buying it as the market continues to dip. I currently have 613 shares of ZUO, and I do not think I'm done building this position. I may add more if we continue to see some serious drops before earnings. However, I want to see what numbers they come out with because we are still early and at a crucial stage of this turnaround. So if numbers are not good, then I don't want to be too heavy quite yet. But if numbers are good, I'll probably be adding much more. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out the quote of the day because you might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace, and thank you.